Strategic media and public relations is bringing together dynamic companies, investors, and consumers like no one before. And we're doing it in a unique way while addressing the big changes underway in our world. Our world is fraught with both peril and opportunity. The world is changing. Long-term conflicts are shaping up over commodities, currencies, and influence. Political lines are shifting. Yet mankind moves on to meet the needs of a growing world. Newer, cleaner energy, medical breakthroughs, ways to better our lives, better ways to move into the future. Join us now for today's topic.
Welcome again. I'm Chris Temple, editor and publisher of the National Investor and also vice president of strategic media and public relations, which we call strategic MPR for short. And today what I want to do is share with you, mercifully a bit shorter than the first one of these things that we did, our part two in our roadmap series. There's a lot of things, as I've said many times, that are going to be one-offs going forward. There are environments in the markets and in geopolitics and the world and trade relationships and so forth that are things that we've never had to navigate before as citizens, as consumers, and as investors. So what this series is going to continue to do for you is to lay out some of these new facts of life that we have to contend with. We're going to look at how they impact you in all of those different attributes, whether it's as a consumer or as an investor particularly, and try and give you at least a heads up as to what we're going to see going forward. Now, before I get underway, and we're going to go through a lot of subjects fairly quickly, a couple of biggies being China and what it's going to do to influence the world in the coming several years, and the commodities markets, which continue frankly, to confuse an awful lot of people. We've had incredible volatility. We've had a lot of things not do as well as one would expect when you look at commodity prices themselves. So we're going to go through those things, kind of set the table for some future versions of this roadmap and so forth. Before I do, I want to remind you that if you're not already, please get on our mailing list to be sure that you keep up with these thoughts. There's a series of other videos coming up, other special reports coming up that are going to isolate some of these themes we're going to talk about in this roadmap series today. So make sure that you are on my free list. Very easy to do, as you've seen on the screen here. Likewise, follow me on social media. I'm most active on X, but a lot of business-related stuff is on LinkedIn. And even if you look up the National Investor on Facebook, there's a lot of things that I'll put on Facebook as well. Those are oftentimes of a more, personal, family nature, more issues than hard and fast investment information or market information as well. So you really want to get in the habit these days, when so much of what is out there is in those forums. You want to get in the habit of doing what I do several times a day and taking a quick lap through all of your social media, see what's new, see what's out there, see what's news, et cetera, et cetera. Secondly, as I pointed out, as some of you still, I guess, don't know, a little over a year ago with a couple of colleagues, I started a second company, Strategic MPR, as we call it. And you want to be sure you sign up with us there as well. We have a lot of investment information there. More so with Strategic MPR, we cover a lot of causes, a lot of things that, yes, involve your investment portfolio and decision making as an investor, as a consumer, maybe as a public or private company trying to get yourself better known, maybe as well as a cause like some of the ones that we have already that we carry water for, so to speak. So you want to keep up with us there as well. Likewise, social media there. You'll want to keep up with Strategic MPR on our own social media channels. Here they are on the screen where those are concerned as well. Later on, as I'm closing this up, I'm going to talk specifically about one of our causes and how that especially dovetails into a lot of the investment world and that type of thing. For today's purposes, what I want to do is talk about some of the things we know or can kind of surmise, I guess, for lack of a better term, what we're going to be dealing with in 2025 and going forward. There are certain things that we don't know, and we're going to have to reserve judgment on some of them until later. The big one, of course, of those is going to be who the political party or parties are here in the U.S. that are going to be running the show, at least for public consumption, when the dust settles in November, if it settles in November. God only knows, we might have a photo finish or contention or whatever. It's unfortunately a good chance of that. Now, whether we have a renewed President Donald Trump, or I guess we can say in some ways a renewed President Kamala Harris, there are certain things policy-wise that are going to be different between the two, of course. I think a lot of that is overrated. Never forget that behind the scenes, and we found this out, sorry, MAGA folks, but we found this out with the first Trump term. We found it out already with the Biden/Harris administration, and we'll see this going forward. The biggest similarity between the two is that neither of them has a game plan for how they're going to rein in the out of control federal spending and federal debt. In fact, whether it's Trump promising just before I recorded this video that in vitro fertilization and other things are going to be covered by your health insurance, he's going to get rid of taxes on tips, which, of course, as you know, Kamala Harris quickly copied and parroted that policy statement, as she has others. Whether it's going to be, in President Trump's case, at least if he gets back in, extending or trying to extend, if he gets Congress to go along, the tax cuts from his first term, which are set to expire next year. All of these different things, there's all kinds of new goodies and gimmicks and promises and things like that. We could spend all day just going over a list of those. But nowhere along the line has either of these candidates intimated at all how they're going to bring down the deficit. So we know that going forward, the federal debt is going to continue to grow. And that's one of the common denominators really in the world, whether it's the US, whether it's Europe, whether it's Japan, whether it's China, which we're going to talk about in just a few minutes, as far as how China is going to have an outsized influence on a lot of these questions going forward. Everybody is in debt so far up to their eyeballs that is going to take a lot of the oxygen out of the room going forward. This guy, of course, is probably the most important central banker in the world. You've heard from him recently when the Kansas City Fed hosted their annual summer picnic and get together out in Jackson, Wyoming a week or so ago. And one of the things that Jerome Powell discussed at that thing, and the conference theme was basically one of trying to push off the responsibility for inflation and whatnot onto policymakers. This is something that I had said the prior year, last summer, 2023, that I thought the Fed and the other central bankers were going to talk way more about, because as time has gone on, and as the creation of money and credit has gone ever more parabolic in the world, just to keep things going. And this is something that's very, very important for you to understand. I'm going to have a whole series of things on this alone. It's my signature essay for many years called Understanding the Game, where I break down in understandable terms for you what fractional reserve banking is all about, why it is that as time goes on, it's impossible to ever pay down any of this debt, pay it off certainly, even pay it down is untenable. And as time goes on, and especially now when we're going to be dealing with the higher threshold of inflation and interest rates going forward than we had, for pretty much the last generation or so, it's going to become a bigger and bigger elephant in the room. The interest levels on the debt, the volume of credit that is gobbled up by governments, leaving less and less proportionately for the private sector. And that is going to be one of just many of the elements that leads to this slow, dull ache going forward that we're going to have in the global economy, the great stagflation, as I've called it. Yes, we're off the peaks for inflation, but no, we are very, very unlikely to go back sustainably to 2% for inflation either. There's too many reasons I've discussed in our prior roadmap number one video, as well as in other videos and articles and interviews I've given and so forth. I've talked about all of the different systemic changes that are going to keep inflation somewhat elevated. Maybe we don't go back to the 9+% peak that we had in the US here a couple of years ago, but neither are we going to be able to go down sustainably to 2% either. The only way that happens, frankly, is if we have a depression. And that, in that case, even we would see a temporary drop in inflation, but then when the government and the central banks have to do more stimulus and more quantitative easing and all the rest of that stuff, it'll come roaring back later on, I think, without any question. Now, at this recent Jackson conference, Jerome Powell actually laid the groundwork for two things. The one that the market was fixated on was, is he going to confirm that interest rate cuts, or at least one or two, will start next month in September? And he pretty much did that. That's pretty much now the base case for the markets, is at least a 25 basis point rate cut. The Fed doesn't want to do more than that if they can avoid it, and for fear, frankly, of panicking the markets and making it look as though, oh boy, we really are behind. The markets were right when they threw their fit in August. We're going to have to hurry up. But I think they're going to do at least something. We'll get a few interest rate cuts into early next year. The magnitude of that is going to be depending on whether inflation does behave or continues to firm up, if not rebound in some areas. And that has already happened. I mean, the Fed got a gift this summer when gasoline prices stayed fairly well behaved. That's one of the single biggest reasons why they're trying to take at least a little bit of a victory lap right now. That may or may not last. Real estate and housing costs continue to hit new records. They just did, in fact, the Case-Shiller home index just hit yet a new record that was reported this week. So there's a lot of reasons to believe going forward that the Fed is not going to get everything that it wants, and that is why in its messaging in Jackson, Wyoming, a week or so ago, they did a second thing that has not been as widely covered, and that is to begin more forcefully to deflect. You know, when they make the rhetorical question or pose a rhetorical question, is monetary policy transition or transmission mechanisms, rather, do they do what we need them to do? Are they efficient and so forth? What they're implicitly telling you, and Powell spent some time in his 16 or so minute speech on this, talking about all the supply chain reasons, policy reasons, and otherwise, that inflation is not their fault. Now, at its core, as the late Milton Friedman said, inflation is always and everywhere a monetary phenomenon. I want to share a couple things with you again on the screen. Some of you who followed me or others that bring this up have seen this before. But the single biggest reason why we had record high inflation in the last couple of years, the highest since 40 years ago when we had double-digit inflation, is Jerome Powell himself. Okay? The Federal Reserve, and pay especially close attention to this chart of the broad money supply M2. You already had, over a period of time, a steady increase in the rate, and you'll see here, not long after the 2008 financial crisis, the long-term trend line turned upward. But then, using COVID as an excuse, the creation of money and credit, as reflected here by M2, went parabolic. And as you see, for all of the talk about the Fed being tight or too tight, for all of this, hand-wringing over, oh boy, they're going to cause a recession, we still, even after the last 2 years, are far above even that accelerated long-term trend line of money growth. This is why the Fed was able to take interest rates all the way up to a target rate of 5.25% to 5.5%. And not really do a whole lot of damage to the economy that is visible. Now, we all know underneath the surface, there's a big swath of America that already feels like they're in a recession. If you don't have a big stock portfolio, if you're not able to enjoy the rise in real estate prices, living costs have gotten tougher, and we've seen all kinds of evidence of that. But the reason why we're going to continue most likely this muddle-through behavior going forward is because of this. Now, secondly, and this has also been well covered, the financial conditions index, the ability of companies to borrow money, yes, at higher rates than they had for a while, has really not been hurt a lot if people have got a good story. Indeed, I think that one of the good things going forward, and I've said this before, is going to be that credit worthy businesses are still going to be able to borrow money even if they have to pay up for it. And if the fundamentals right and the economics work for the companies, everything will be fine. But there's going to be less of it to go around. And here again, I think one of the reasons why the Fed has delayed until the first cut comes, 3 weeks from now, as I'm recording this, in cutting interest rates, is that there is still so much of this liquidity sloshing around out there, and they know they've had some margin for error. They have the political cover, of course, to do it now with the jobs numbers and employment numbers having turned a bit worse, and we'll see what happens the Friday after Labor Day, when we get the April numbers out. But this is why the Fed is still going to be slow as they think they can get away with. There's still so much of this liquidity out there. So I've said for a while that the inevitability is that the Fed is going to have to begin cutting before inflation is tame. We're getting a little bit of that indication now. I think the Fed will continue to cut even if it's on and off well into 2025, and even if they don't get much more help from inflation. And they're going to continue to blame everybody but themselves. Here's an oldie but a goodie, a real quick clip from the famous movie The Blues Brothers. This is Joliet Jay now.
No, I didn't. Honest. I ran out of gas. I had a flat tire. I didn't have enough money for cab fare. My tux didn't come back from the cleaners. An old friend came in from out of town. Someone stole my car. There was an earthquake. A terrible flood. Locust. It wasn't my fault, I swear to God!
And a while back, when I was talking about this very thing, I had my great cartoonist Jerry King do a cartoon of Joliet Jay Powell channeling Joliet Jay blues and telling Mr. and Mrs. Consumer that inflation was everybody's fault but his. It's COVID, it's supply chains, it's Vladimir Putin invading Ukraine, it's this and that, it's everybody but me. It wasn't my fault, I swear to God. And we continue to get that from the Fed. And of course, when we have so much political cover, really with both parties in Congress that deem the central bank and its fatally flawed system as sacrosanct, it's no wonder we're not going to get any real solution to this. We're going to continue to see debt go up. We're going to continue to see it become harder and harder for the economy in a broad sense to even service that debt. And that's what we're going to deal with going forward. So one of these common denominators, again, whether it's the Republicans or the Democrats that control Congress or the White House, the debt monster is going to continue to be a bigger and bigger part of our lives, take even more of the oxygen out of the room when it comes to the economy and so forth. And it's going to cause a terrible slog. And I mean, frankly, with when you look at the last few years, all of the growth from future quarters and even years that was stolen from all of this COVID stimulus or by all of this COVID stimulus, now we're going into a recession where everybody has got a bigger debt burden. In some respects, not as bad maybe as what we saw in 2008, but still it's going to be a chronic thing going forward that people are going to start to sit on their hands a bit more. And it's going to cause the economy to bog down. And at this point, the Fed trimming short-term interest rates is not going to change that. In fact, and I'll say this again, don't be shocked if a year to 18 months from now, the Fed has taken short-term rates down to maybe 3%, give or take a little bit, from their current 5% plus, and yet long-term borrowing costs will be higher than they are right now because of the volume of credit that the government is taking up with new debt and refinancing old debt. And as the bond markets properly, and they've done a lot of this in the last year or two, demand more of an inflation premium. And increasingly, as we're going to talk about in future episodes of this roadmap series, a currency risk premium and even a sovereign risk premium. So be prepared for that going forward. Now I want to segue into spending a few minutes specifically on China because the abuse of credit and debt in that country has brought the world to a very interesting place right now. Long before the ECB and the Bank of Canada, and now coming up the Federal Reserve, backed away from their monetary policy tightening and started to go in the direction of easing again. And again, that you've got to keep in the back of your mind that there's still a lot of liquidity in markets, no matter what the price of that liquidity is. China made the decision going on a year and a half ago now, if I remember correctly, to go very, very much in the other direction. Some of you remember, and I've talked about this repeatedly, the biggest bankruptcy ever on the face of the planet, China's Evergrande, hundreds of billions of dollars of debts at stake in the overbuilding and over-leveraging of China's real estate market. For a while, China was thinking that, okay, we're going to try and step back from the Keynesian and debt idiocy that we've mimicked, that the West gave us, and we're going to start to make people eat some of these losses. That didn't work real well, and China started to get concerned. At the 5-year plenary, as they call it, that China's government just had, they are deathly afraid that even now, as they are full tilt boogie, inflating the money supply again, trying to keep interest rates down, trying to continue to paper over what is a world leading debt to GDP ratio. As they do all this, they've realized that we can't really impose losses on everybody. We've got to continue to do the old adage, inflate or die. So you've got that against a backdrop of a country that again became so leveraged. And I can't say this often enough when I talk about China. There are so many misconceptions that people have about China and its system and so forth. If you turn on Fox News, none of the anchors and talk show hosts can mention China without calling them CCP, the Chinese Communist Party. This is, of course, one of the big bogeymen that justifies zillions of dollars of defense spending. The other big one, of course, being Russia. What is communist about a system that has gone way beyond anything that Alan Greenspan or Ben Bernanke or Jerome Powell ever dreamed, as far as creating endless quantities of fractional reserve debt, getting a system over leveraged? When you look at the grand total debt to GDP ratio in China, you're well over 300% by most figures. That's greater than Japan. That's greater than Europe. That's greater than the US. Now, what China has had going for it to a certain extent is, in some respects, yes, their command and control structure makes the People's Bank of China a part of the government itself, unlike in the West where the central banks are pretty much autonomous, and if they screw up, then the elected officials have to clean up the mess somewhat after that, along with the Fed. In China, it's the other way around. But nevertheless, the math is the same, no matter what you want to call the system. When you so over leverage an economy that you create all kinds of, you've seen and heard about the ghost cities in China. You've heard about all of the overcapacity in China. And this is going to be an interesting wrinkle to the whole world's inflation equation, as it might be, when we still have inflationary pressures in the US and maybe lesser so in other countries in the Western world. And yet in China, they have been embarked on, again, for well over a year now, on a quest to keep outright deflation at bay. Here's an interesting thing. I mentioned a few minutes ago when it came to Treasury securities that there's been a lot of upward pressure on long-term Treasuries because the markets finally get the fact that we are going to have higher inflation and higher interest rates for longer than anybody wants to admit, including right now the Fed. Therefore, we've had the bond market vigilantes, those creatures that we all thought were extinct starting about 1981 or 82. They've been making a comeback. In China, in great distinction, we have seen a situation where people have been tripping over one another to buy Chinese 10-year debt at less than half recently of what treasuries are selling for. Now, if China's so over leveraged, if their economy is so dead in the water, why are people wanting to buy 10-year paper at not much over 2% in China when recently they wanted more like 4%, maybe a little bit less than that right now, to buy 10-year paper from Uncle Sam? And the answer is that markets understand that China has only one direction to go, and that's the same road Japan traveled for the last 30 years. After its financial bubbles burst, the stock market in 1989, real estate a couple of 3 years later, Japan was basically a stagnant economy and had stagnant markets. And when prices were actually falling for a lot of the last generation in Japan, it made sense if you were looking at the Japanese economy and the inflation equation there. It made sense for you to want to own Japanese bonds that weren't yielding anything, and in fact for on and off negative yields when prices were falling even faster. Now that is reversed in Japan finally after 30 plus years of this. But China is now looking at going down that same road. What does that mean for us? What does that mean for global markets, for trade, and so forth? Well, all you've had to do recently is read the newspapers and see that the Biden administration, which was supposed to be a China lackey, okay, you remember China Joe and all that kind of thing, they just slapped 100% tariffs on imported electric vehicles from China. They slapped tariffs on other imported things, mostly to do with the green economy, which we're going to get to when we wrap this up in just a minute. Canada, of all countries, and of course, partly because Canada, as we euphemistically know them, is the 51st state, and they pretty much do what we do. Justin Trudeau has also just slapped similar, if not identical, tariffs on imports from China. Now, Chinese electric vehicles are littering loading docks and ships the world over. They've made so many of them that they're pretty much giving them away. Now they have the ability to give them away because they have a much different cost and supply structure than we do here in the West. And this is going to be one of the big stories going forward, especially for a lot of you bullish on commodities, and I'm bullish on commodities longer term. But it's going to be a very convoluted mess because you cannot right now, if you're the US or the EU or Canada, compete whatsoever with electric vehicles manufactured under different standards and with cheaper inputs in China. It just doesn't happen. And we all see that. How we resolve that remains to be seen, and that will be one of the big differences between, for example, a Trump and a Harris administration going forward, I believe. And I'll get to that just a second when we wind down. But for present purposes, when you need, let's isolate this to China versus the U.S. In the U.S., you still need going forward a robust economy to even be able to service debts, even as interest rates get trimmed a bit on the short end going forward by the Fed. But you cannot do that if U.S. businesses are unable to compete with China. So the West, one of the choices, one of the Hobson's choices, I guess you'd call it, that the West is faced with is that, okay, if you don't want China to implode and take everybody with them, at least for a while, then you have to hold your nose and say, okay, we're going to throw in the towel. We're not going to develop our domestic energy and EV industries. We're just going to have to take cheap Chinese imports because that's what everybody can afford and that's what people want. That's not going to sell real well. And I don't think, frankly, even the Harris administration, let alone a Trump administration, is going to settle for that. But you've still got this looming economic problem, and it's one of simple mathematics. You've got a Chinese economy that has been listing for a while. It takes more and more money and more cheap credit just to keep things from imploding. Consumers over there aren't spending money. They don't have the values that U.S. consumers do. They don't think that it's patriotic to go out and run up your charge cards and buy more than you can afford. So that continues to be a major impediment going forward to China being able to carry its weight and absorb some of its own stuff. So now they want to go back to what we thought we were done with some time back, and that's dumping all of their excess production on the rest of the world. That's going to be a chronic thing going forward that's going to impact commodity markets and a whole bunch of things. And you better get your head around that. Again, if you're a consumer, a citizen, an investor, a company that maybe is in a commodity space, you're trying to figure out how to make yourself relevant, understand these macro things that are going to make life difficult for you. I want to jump now somewhat into a broader discussion on commodities specifically and economic growth generally going forward. Again, it's not going to matter who gets in the White House as much because a lot of these things, the debt's involved, China's role in all of this, these are already baked into the cake. You're going to get some tweaking here and there depending on the outcome of the November election here in the U.S., but the big core story is not going to change. Some of you know that back in the spring this year, I went to 2 conferences back to back at which you had both commodity industry, engineering, a lot of the supply chains to build the green economy and the broader economy generally when it comes to infrastructure and conventional energy and so forth. One of them was in Washington, D.C., the other one was in New York. And both of those meetings had both public and private speakers there. And one of the things that I think became very clear in both of those conferences, and this is even people within the Biden administration at the Department of Defense, the Department of Energy, and so forth, they realize that we have brought a knife to a gunfight when it comes to what I've already termed as an ongoing and already commenced World War III over commodities and currencies and things like that going forward. And I'm going to paraphrase one of the ladies from the Energy Department who was at the Washington meeting that I went to, and she pretty much said that we have a terrible disadvantage when we're dealing with a major competitor, meaning, of course, China, that looks at things from a very simple, I think, approach, maybe more simple than we think it should be here in the West, but it's nevertheless, it's a reality. It's a fact of life. What do we need? How do we get there? And let's put things in place to do it. Now, that does mean in some respects that the environmental standards for China to meet its goals and to be able to sell electric vehicles in its country and around the world, for example, are not what we would do. But we're at the other extreme. This lady pointed out, we wring our hands in the U.S. over spending 20 years or longer to figure out how we're going to do all these things, and we wonder why we can't keep up with China. That's something that's going to have to change. Now, in the recent past, I've been on a couple of industry webinars, one and 2 great organizations, especially if you're in the industry in any way, shape, or form, or you're an investor wanting to get the facts, not propaganda that some sales organizations put out on commodities and whatnot, but facts. You need to follow organizations like Benchmark Mineral Intelligence. You need to follow organizations like SAFE, Securing America's Future Energy. Those 2 are ones that I was recently on webinars with, and I'll tell you what, when their analysis of China is even more dire than what I've just told you here in just a few minutes today. And of course, we're going to talk about all these things going forward as well. Where China's concerned, this country realizes that in order to keep itself going forward, it's got to swamp the rest of the world in cheap goods. There's just no other way to do it when they've got all this overcapacity, all this over-industrialization, with all of the associated debt. The only way they continue to service that debt is to undercut the rest of the world. Now, it's one thing to talk about how here in the U.S., for example, we're going to change all that and finally get permitting reform, finally be able to have a bit better growth and a bit better ability to control our own economic destiny. And yes, there have been some things out of the Biden administration, even through the IRA, through the Defense Production Act, and so forth, where there have been a relative handful of projects that are going to meet our critical minerals needs here within our own 4 walls, or with allies, for example, like in Canada. Some of these things have been funded, but folks, it's a pimple on a flea compared to what we need. And again, one of the things that's going to be very stark when we get into next year, the political season is over with, and whoever is running things is going to be faced, okay, are we really going to be serious about how we're going to compete with China and be able to regain our national security? Because as this great piece pointed out recently out of National Review magazine, mineral security is national security. We have no national security if we don't have the ability to build things ourselves, certainly to a greater extent than what we have now. I've said it time and time again that it wasn't just sneakers and t-shirts and doodads and electronics that we outsourced to China chiefly and to other countries secondarily in recent years. It's been pretty much everything. The ability to build the EVs, the windmills, the power grids, and so forth, even the things that we need for the military. You know, the latest thing that China just did is to impose export controls on antimony. Some of you who followed that story know that this is not the first thing that China has done this with, and it puts us in a bad place. Antimony is a very key strategic metal. We don't produce any in the U.S. today. There are a couple of projects of some interest in the U.S. and Canada that would replace that, but it's going to take years for these things to come into being. So there are a lot of reasons, and I'm going to share just this one chart right now because I'm going to be doing some specific broadcasts and podcasts and written reports on commodities in a very, very near future where I dive into all of them. But we have such a dichotomy right now because when you look at this one chart here, and I've used this many times, and this is globally, the need and the demand for all manner of inputs, whether it's oil, whether it's coal, whether it's natural gas, whether it's base metals, everything goes up every year. You know, one of the companies that I cover, they go out of their way to talk, you know, in terms of energy. We are not in an energy transition. We're in an energy addition. Every year, the world needs more and more energy from wherever it comes. For transportation, for power grids, that's been added to by AI. It's been added to by data centers, as many of you know. Where's it going to come from? So we've got that situation on the one hand, but on the other hand, we've really hobbled ourselves when we look at the U.S. specifically. You know, there was an article here recently, here's this one on the screen as well, that is basically that the West is a laughingstock. When you consider the idea that, you know, whether it's the mandates that Biden/Harris have come out with or anybody else, you know, it's Looney Tunes. Where are we going to get the things? You know, I've quipped before that some of these policymakers think electric vehicles, you know, to look at that specifically, come out of some magic extrusion machine, and they're all going to be powered by fairy dust. There's no inputs needed. These things are going to happen magically just because we're going to will them into being. Sorry, it doesn't work that way. And we've learned that the hard way. You know, President Biden had that iconic photo op sitting behind the wheel of an F-150 Lightning, a Ford electric vehicle. Ford has curtailed most of its EV plans now because they've lost their rear end on this. The math doesn't work, the supply chains aren't there, the inputs aren't there, and the market is not there. So you've had very poor planning go into this. Yet, until very recently, the Biden administration was sticking to its guns. And here's another great Jerry King contribution to my own propaganda. You know, we've had Pharaoh Joe telling us, no, you can't have any inputs. No, I'm not going to let twin metals in Minnesota and the polymet in Minnesota and its new manifestation. I'm not going to let resolution copper in Arizona and some of these other projects get built. But your tally of electric vehicles shall not diminish. Doesn't work. The world's starting to figure that out. The economy is starting to figure that out. So we've got the demand and the need going forward, but policy has hamstrung that. And you need to understand that. And again, I'm going to get into a lot more details on this going forward because there are some great commodity themes out there. There are some great commodity stories. But right now, commodities, and I'm speaking in general terms, okay? Commodities have got two substantial headwinds. One is this ongoing policy disconnect where the policies more often than not hinder rather than help the development of things that we need. The second thing is, as the US economy and global economy weaken, as debt levels are increasingly difficult to cope with, where is there going to be sufficient economic growth, number one? Number two, in selected commodities and industries, where are the fundamentals so strong, where supply is concerned, that a bull market can assert itself or maybe reassert itself despite economic slowdowns and debt issues and whatnot? That's going to be another thing. And number three, is there going to be any added policy stimulus that will actually help commodities going forward? I think there is going to be some of that. One of the causes that we talk about on our strategic NPR website speaks to this. I want to end quickly with a shout out to my buddy Ryan Sistad, who is the chief cook and bottle washer for Better in Our Backyard. They're a Duluth, Minnesota based organization. I've been privileged to be involved in a number of activities and even got some golf in so far this summer. And I'll be at their golf tournament in the middle of September, which is a big event for them at that time of year out in Cloquet, Minnesota. But Ryan put on an event back in July that I was privileged to be at. I took a few of my older grandchildren, one of whom is especially interested in these topics and getting into journalism and so forth, so that makes me especially proud, as you can imagine. But while we were at this event, I had the ability to speak for an extended period of time with the Duluth area's own Congressman Pete Stauber. He's a Republican, unusual to have Republican members of Congress or the Senate, and very heavily DFL Minnesota. But Pete's a good guy, and he's been in the forefront of trying to get America to get their heads out of our collective rear ends and understand that we have the ability right within our own four walls, and in this case specifically in northeast Minnesota, the storied Iron Range area, to meet a lot of our own critical materials needs right in our backyard. And that's going to be a theme we're going to talk about going forward. I think this is something that, and I never hear a single question about this from any of the media to either Trump or to Kamala Harris. Both of them should be asked, okay, cut the nonsense, cut the gimmicks, cut the sales pitches, cut the political garbage, and tell us how physically are we going to meet these needs for all of our energy needs going forward, not just electric vehicles. What are you going to do about the Iron Range? She should especially be asked about that, given that she has picked Minnesota Governor Tim Walz as her running mate. Let's hear what Tim Walz has to say about his own home state. Is he going to get behind the cause of furthering our economy generally and our green economy specifically by helping to make sure that these things don't stay bottled up? Because folks, in the U.S., and again, I'm beating a dead horse here, it takes the better part of 20 years to permit anything. It's been 25 years since yours truly personally set foot on a North Met project as I became aware of it. And yet today that is still not in development, a project which is the single largest by volume source of copper, nickel, cobalt, platinum group metals, and others when you combine it all together of anything in the US of A. And yet the Biden administration has kept it bottled up. It's completely shut down a next door neighbor, Twin Metals. So we need to understand that to go forward, and this is going to impact us as investors, it's going to impact us as consumers, as citizens. If you're a public company, and even if you're one of the fortunate ones, and there's a couple I followed, another one I'm about to add to my recommended list, even though its stock chart looks like a dog's regurgitated breakfast. Everybody needs to address going forward, when and how will our projects be relevant? When will they be relevant to the economy? When will they be allowed to be produced and so forth? So, I don't want to ramble anymore on this particular point, but again, it's critically important to understand that going forward, there are still as many impediments as there are tailwinds to this whole commodity story. And it's because of policy. It's because of China really having its thumb on the scales in the wrong direction, where we're concerned here in the West, and a whole lot of these things. So anyway, that's a few of the things that we're going to be dealing with, no matter who is in the White House, no matter who controls the House and Senate, come 2025. For more information, again, I'm going to put our contact information on the screen. Make sure for more of these videos and the written reports that we're going to have to go along with them for future podcasts and so forth. Make sure that you're on both of our mailing lists with the National Investor as well as Strategic NPR. There's a lot that we have for you as far as causes of things that we need to worry about in a broader sense, as far as public policy issues and so forth, and especially when it comes to investment markets and so forth. How do you navigate this economy and these markets going forward? So thanks again for tuning in today. And the next one, to give you a quick teaser, we didn't spend any time on it today because it's a subject in and of itself. How will all of these things and China and commodities markets and the pricing of commodities be affected in the years to come if all of a sudden these things are no longer, as they've been for 2 generations, priced globally in US dollars? Is it really true that the dollar is in its death throes? Is it really true that a BRICS currency of some fashion is going to, quote, replace the US dollar? Just how real or imagined is this rebellion against the US dollar and US hegemony going forward? And how, especially for us here in the US, that will be directly affected by any significant change in the dollar's reserve status, how is this going to affect us? What do you do in response to it, and so forth? And of course, as always, we're going to separate fact from fiction, because there is also a lot of utter nonsense out there when it comes to the death of the dollar and Fed now and Biden bucks and all of these things as well. So shortly following this roadmap, we're going to go to episode number 3 that is going to be specifically what will be the makeup in the coming years immediately ahead of us of the global payment system, of currencies and so forth. So you're not going to want to miss that. It's another reason to make sure you're on our list, to make sure that as soon as those are out, you know about it. Thanks again.
We hope you got a lot out of today's subject. Make sure you avail yourself of the resources and contacts offered today. Subscribe to this channel for future topics and opportunities. And if you have any questions, drop us a line. Thanks for tuning in.